This is the week ahead for the week starting Monday, the 28th of July, and it's going to be an absolutely massive week. We've got earnings separate from what we're covering in this. But we've also got a raft of economic data points, central bank decisions, and the week finishes with that 1st of August deadline on tariffs. The week just gone has seen a big focus on trade deals. Of course, Japan across the line, the Philippines across the line, the EU apparently getting close to it. And so what's going to happen in the week ahead? It's going to be an absolutely massive one. So let's get into the top 3 areas we're looking at for the week starting Monday, the 28th of July. So first and foremost, here are the top ticket items according to Trading Economics. And you can see here on Wednesday, we see a raft of GDP figures coming out of Europe, most notably there. And ultimately, that takes us into a period where it's all about central banks. So we've got the likes of the Bank of Canada interest rate decision expected to remain steady. The Federal Reserve expected to remain steady. Then we go into Thursday where the overnight manufacturing PMI figure comes out of China. The Bank of Japan interest rate decision with markets expecting a 25 basis point hike, but that certainly isn't a foregone conclusion. Then we've got inflation out of the Eurozone with the likes of the French number, the German number, the Eurozone figure is on Friday. We've got the core PCE price index number coming out on Thursday from the US. And then the week wraps up with the jobs report. So an absolutely massive week ahead. It's difficult to really try and pick the bones through all of that, quite frankly. Now, in terms of the US perspective, like I said, we have got the trade talks ongoing. If we get some of those across the line, that has a tangible impact on financial markets. We've already seen that over the course of the past week. But then alongside that, we've got the FOMC meeting. Of course, Donald Trump consistently trying to push Jay Powell into cutting rates. Doesn't seem too forthcoming on that front, and markets expecting to see more of the same, really, and that is rates steady as they await to see exactly what's happening in terms of inflation pressures after tariffs have been implemented. Now, the fact of the matter is that we've seen some of those reciprocal tariffs pushed back and pushed back. Well, the new pushback took us to the 1st of August. And of course, for the Federal Reserve, they will want to see what tariffs ultimately look like and what implications that has upon the economy, what that has upon the inflation numbers. And so, if he does stick to this deadline, this hard and fast deadline, that at least gives us an end in sight for when we can at least see how that impacts the economy. And then the likes of Powell and the rest of the FOMC will be able to make their decisions off the back of that. Without that, I think it's quite difficult for Powell, despite the pressure being put on him and the fact that inflation thus far has remained relatively subdued. You could say, well, tariffs in their current format aren't necessarily massively inflationary according to the data we've seen so far. There's 2 ways of looking at that. Number one, you could say, well, those tariffs haven't really fed through into the economy quite yet. Many businesses stockpiled ahead of the tariffs, and therefore they have to work through those inventories first. So there could be a delay in terms of those tariffs really causing inflation. The second side of it, you could say, well, many of these countries have got, say, 10% tariffs, and soon enough, on the 1st of August, they could have 50% tariff, for example. So therefore, we have a change of the state of play. So that's the basis for the Federal Reserve to remain steady, and that's exactly what we are expecting them to do. The key thing here to note is that we are now starting to see trade deals come into the fore. And if we continue to see those trade deals achieved, we have to essentially then gauge exactly what the direction of travel is for the economy and alike under these new terms. Now, these trade deals do have tariffs built into them. The UK has 10%, but the UK had a deficit with the US. So it was always an easy trade deal to have. Elsewhere, it's 15%. The likes of the EU likely to go down that path. The likes of Japan, 15%. Indonesia, 19%. So we do have levels of tariffs or taxes, essentially, that will have an implication for inflation. But I do think, if we're essentially talking about tariff levels in the 10%, 15% realm, that doesn't look like it's going to be hugely inflationary. Some of the costs are passed on to the producer. Some are borne by the consumer. Some are borne by the importer. So it kind of gets spread out. And so if you've got, say, 10%, then, a little 3% bump in the price is not necessarily massively problematic. More of a problem when you've got, say, 50% tariff and the entire thing gets put on the the consumer in the US. That's where it really starts to take a toll. So in terms of the expectations for some of the numbers, of course, we've got the jobs data coming out over the course of the week. So we've got job openings expected to decline. ADP payrolls expected to improve, but still remain low at 20K. GDP growth rate for the second quarter expected to be at 2.5%. Core PCE price index, this is the Fed's favored inflation metric, expected to rise to 0.3 for the month. And then at the back end of the week, we've got payrolls. Weaker payrolls expected, higher unemployment expected. So that would point towards a weakening of the economy. I would be hesitant on this front because ultimately we keep thinking this is going to happen and we keep seeing outperformance. I think the last 3 months we've seen the payrolls numbers coming in better than expected. So what's to say it will happen this time around? And that's not just a low bar. In terms of the inflation front, you can see here that so far we've seen 3 months of relatively calm inflation. The June numbers on both headline and core CPI were higher. So does that provide the basis for a similar kind of move for the core PCE price index figure, therefore sort of quelling any claims that we're going to see rate cuts coming into the fore? Potentially. So if we're talking about the possibility of a weaker US economy and US jobs numbers, but also higher inflation, then you're talking about that sort of stagflation picture coming into the fold. There's so many different potential moving parts over the course of the week. We've got all of this data. We've got the FOMC meeting and therefore their outlook. We've got the possibility of some breakthroughs on trade talks. So it's quite difficult to really gauge exactly how all of this is really going to shake out when it comes to the back end of the week. You can see here in terms of inflation, when you're looking at some of the prices elements within the ISM manufacturing and services PMI, generally, you'll see a sort of 6-month lag within this. So I've built it into this model. It points towards a potential for an uptick in inflation over the near term, which does make sense if we don't necessarily sort of put a cap on some of these tariffs. So that, of course, is the fear for the Fed and many others. In terms of expectations, markets expecting a near 98%, so over 97% chance of a pause this time around. Then the next rate cut priced in for September. Beyond that, we're looking at the possibility of another one at the back end of the year, be it December, be it January. That's what markets are expecting. So it's between 1 or 2 rate cuts for the remainder of the year as markets are currently seeing it. But like I said, you've got the one side of it where people are thinking we could see a deterioration in terms of the US economy. And by and large, I haven't seen that thus far in terms of much of the data has remained relatively strong. The other side, you've got the question mark about inflation. Is that going to pick up? And that, of course, could hamstring the Federal Reserve if we see a significant uptick in terms of the core PCE price index. So a lot to go through. The outlook from the Federal Reserve is going to be absolutely key. In my mind, I think if they continue to get trade deals across the line, that forms the basis for us to see the Federal Reserve cut sooner rather than later. So that will be really key. I mean, I know that Donald Trump is desperate to replace Powell because he thinks he's too late in cutting rates. But ultimately, it's the framework that Trump has put into place, the uncertainty that everyone has. All economists have uncertainty over exactly how this is going to shake out. That's what has provided the basis for the Federal Reserve to take the stance that they have right now. So if you had to give them more certainty, and even if that certainty is 15% tariffs, right, on a certain country, but that's what it will be. At least you have certainty, and then you can see the outcome to a degree, and then you can take decisions. But consistent uncertainty in the future over how things are going to look, it's very difficult for anyone to know exactly what they should be doing. So the Federal Reserve certainly showing that at the moment. So in terms of gold, I think this is a really interesting market to be following at the moment. Just going to extend this line out here. So you can see here that we do keep kind of coming back into this trend line support. So we sort of time and time again, that is the sort of general area where we see the bulls coming back into play. More recently, we've been seeing this pullback here. And part of it in my mind is this idea that we're going to see Jay Powell potentially pushed out. And that is going to be a theme over the coming week. Of course, he's being reported to the DOJ over a potential misappropriation of funds. Quite exactly how that is going to shake out remains to be seen. But of course, there is a perception if he's replaced, then he's going to be replaced with a yes man. And if a yes man comes in, and suddenly he's going to convince the rest of the committee that they should be cutting rates over and over and over again. That might not be the case. But nonetheless, we have that side of things. The flip side of it is you have these trade agreements that are coming into play, and there is a perception that gold does well when you see trade sort of relationships broken down, and then particularly when it comes to the US, because there's a flight from US assets, a flight into other havens, so away from, say, US treasuries towards something like gold. We've seen the BRICS nations really stockpiling gold over the years, and so if we see a sort of deal brokered between the US and China in particular, that's not great for gold. The idea that the US and China are at loggerheads is actually a basis for strength for gold. At the flip side, if we're looking at the sort of big picture of how things could shake up over the coming week, you're going to be looking at what the perception is around interest rate cuts for the Federal Reserve. So do we see data coming in weak in terms of the jobs numbers? And in which case you could say, well, that means that we could see additional rate cuts. Or does it come in terms of elevated inflation rates? Higher core PCE might make us think that it could take longer for us to see rate cuts. Rate cuts inherently are good for gold. So if we do see something that points towards significant rate cuts coming in the near future, that, for my mind, should be good for gold. Ultimately, set against the backdrop of rising debt, national debt levels, yields on the rise. I pulled back a little bit recently. That provides the basis also for strength for gold. Now, in terms of the chart here, like I said, we've seen repeated pullbacks in towards this trend line. We've just seen something quite similar here. This deep pullback taking us between the 61.8 and 76.4 Fibonacci level once again. And the bull's coming back into play. Whether this is the low or whether we come back into trendline support or not remains to be seen. But for me, as long as we remain above trendline support, as long as we remain above the 3309, I remain bullish for gold as we try to sort of resolve this consolidation that's been taking hold over the last few months and try to resume the uptrend that was playing out at the beginning of 2025. Next up, let's look at Japan. Japan's been in the center of the news headlines over the course of the past week. Of course, we kicked off with the weekend election results where we saw the upper house election essentially go against the LDP party, which is the reigning party within a minority. But essentially, they lost their majority in the upper house. They've already lost it within the lower house. It points towards a potential change at the top, a potential for the prime minister to leave Ishiba, and therefore it raises question marks because part of why he lost that majority was because of the austerity measures, because of the idea that he didn't necessarily want to be embarking on stimulus measures to the extent that some of his opponents might have been pushing, because there is a crunch in the Japanese economy where we've seen elevated inflation, wage growth now rolling over, but also wage growth for many would have been outstripped by inflation. So people are struggling with higher prices. They're certainly not used to it, and they want additional stimulus. The problem is that additional handouts would drive up yields. It drives up the cost of borrowing. And this is one of the most heavily indebted, if not the most heavily indebted developed country in the world. So that would be problematic and potentially drive the Japanese yen lower as a result. The flip side of that is strong Japanese yen is bad for stocks, whereas a weak Japanese yen is good for stocks. So you have this sort of perverse situation where a rise in terms of borrowing costs are not good for the economy, but by and large, it ends up moving alongside the Nikkei 225. So, like I said, we have got a number of key events coming out over the course of this week. We've got industrial production, retail sales. We've got the BOJ rate decision, where we're seeing here that we're expecting to see a rate hike of 25 basis points. I actually didn't add it on to this pack, so I'm just going to check it. But according to Icon, that is not the case. According to the Icon platform, they're pricing a rate hike of 25 basis points like October, December kind of time. So that signals the possibility that, don't look at this and think they're definitely going to hike. According to the Icon platform, that they're probably not going to hike. And that probably stands to good reason right now. Now, if we're looking at some of the sort of data points, like I said, we've been seeing long-term yields on the rise, problematic for a country that is so heavily indebted. That relationship between the rise in the 30-year yield and the Nikkei 225 highlights why we continue to see yields on the rise, but the Nikkei hit a record high last week. Now, bear in mind, they've apparently said that they're going to invest in a $550 billion investment fund that goes into the US. Quite where this is going to come from remains to be seen. The annual GDP rate of the Japanese economy is just over 4 trillion. So 550 billion. It's not necessarily a small number to start trying to find, especially for a country that borrows a lot, has a huge amount of debt. And like we can see here, borrowing costs on the rise. So like I said, what you have is this relationship between the likes of the Nikkei 225, dollar yen, or essentially the yen, and the likes of the 30-year yield or treasury yields over in Japan. So if we were to see something along the lines of a rate hike, that would likely drive up yields, right? And so you're pointing towards a possibility that it would potentially drive down the Japanese yen, potentially drive up Nikkei 225. Essentially, if we're looking at the sort of the chart in question here, and I wanted to bring up the likes of the pound against, I wanted to bring up the Nikkei 225. If we're looking, it's a very clear-cut trend in play. And like I said, the difficulty here is the fact that we're also having to weigh up the implications of what's happening from a political perspective as well, right? So you have the possibility of someone coming in to replace the Shiba. What does that mean? Well, that would mean the potential for increased spending or stimulus, and that drives up yields. Okay, that's a negative, but this increased stimulus is potentially good for the economy, good for stocks in particular. And so the bullish trend we're seeing at the moment, granted, a lot of it is associated with the fact that we have this trade deal with the US, but you also have the fact that yields are on the rise. That's driving the Japanese yen lower, and a low yen is good for Japanese exporters, and you have that inverse correlation. So that ends up driving the Nikkei higher. At the moment, we've seen this spike. If we pull back, then it looks like it's likely to be a retracement. If we see a breakdown through your price swing low, which is 39457 at the near term, then that points towards it potentially breaking down from there. But the way things are shaping up at the moment, very bullish chart. We've now broken up through resistance. We do still have that one big high up here, 42478, to be watching out for. But yeah, that exuberance that we've just seen, maybe we see a bit of a retracement or some sideways price action over the near term. But I do think that we have got the basis for the bulls to remain in play, and certainly if we see a little bit of a pullback or retracement, be watching out for signals that is then resuming back in the direction of the prevailing bullish trend. And finally, let's look at Canada. Now, we've got a rate decision from Canada as well. We have the likes of the GDP numbers on Thursday. Then we've got the PMI number on Friday as well. Notably, don't have the Canadian jobs report, which typically goes hand in hand with the US jobs report. But this time around, it looks like because it's on the first of the month, they've pushed it a week later. So sometimes you see them split up. It just depends on what kind of part of the month it falls on. Nonetheless, markets expecting to see the Bank of Canada stay put here. Now, of course, one of the big stories we've seen recently is the breakdown in relations between the US and Canada when it comes to trade, when it comes to the imposition of tariffs. It's not been pretty to watch for supposed allies and neighbors. It's been a tough one for the Canadians in particular. Now, the USMCA has shielded them from some of that, not all of it. And some of the sector-specific stuff is particularly troubling. We have seen a significant pullback in terms of exports to the US, much more so than the pullback that we've seen in terms of imports from the US. So the Canadians being hurt more than the US are within all of this. In terms of inflation, what's notable here is that we've got sub 2% headline CPI. That has provided the basis for the Bank of Canada to continue to cut rates over time. But we've been seeing core inflation rising somewhat over the near term. So does that mean that the Bank of Canada starts to ease off the gas? Do we see them suddenly start to change tact? Notably, they have been cutting rates more than most. So the Bank of Canada is the purple line. So we've got the SMB in Switzerland, which pretty much a flat, pretty much a zero now. We've got the ECB, which is roughly around that 2%. They've just had a rate decision. And we have the Bank of Canada. So the Bank of Canada have already cut rates to a very significant degree. Remember, they raised rates much higher than the likes of the ECB and the SMB. So it's not like they should be at those levels. Where is the neutral rate? Probably not zero. So the idea that it's come from roughly zero to where it went, it's not going to go all the way back down to there. So the question mark here is, where is that neutral rate? Cutting rates obviously is meant to be stimulative, and if they feel like the economy continues to need it, then they'll continue to do it. But you also have to counterbalance that against inflation. With that core inflation metric on the rise somewhat, there's going to be some question marks coming into play. In terms of this decision, you can see that market's pricing just a 4% chance of a rate cut this time around, and the next rate cut coming, who knows, potentially not this year. And so that's a shift. That is a shift. And notably, I wanted to put that against a currency that is an interesting one, because when it comes to the UK, when it comes to the pound, you do have question marks around the direction of travel for the UK economy right now. It's definitely struggling. You have got the potential for rate cuts if inflation were to allow it, but inflation in the UK definitely not ideal. Because it continues to rise over the past few months in particular. But certainly, if we do see the Bank of Canada move into a sort of wait and see phase or a more patient approach because of that rise in terms of core inflation, then you do have the possibility of this chart sort of rolling over. For the time being, we've got a very clear-cut bullish trend in play here. But we've seen this pullback. We're coming towards this area of support. I've already got drawn on 183 essentially. And a break through that support level does start to paint a picture of potentially the pound weakening against the Canadian dollar. And so, you potentially start to unwind some of this move. It depends on a couple of things, right? So what do the Bank of Canada think? Do they worry about that core inflation metric, or do they just want to keep stimulating the Canadian economy while they try to strike deals with the US? On the flip side, on the UK side, what's going to happen in terms of inflation? Is it just a fleeting move? Are we going, and it's policy based? The likes of national insurance contributions haven't been pushed higher by the Labour government for businesses. Are the Bank of England going to just look beyond that and decide that the UK economy needs help and needs to cut interest rates? Definitely needs help. If they do start to step in a meaningful manner, we could be looking at a potential sort of top and a rolling over of this chart. Notably, if I was to, let's see if Brent has an impact on this chart, but you often have the likes of oil prices benefiting the Canadian dollar. So if you were to see higher oil price, you should see weaker sterling CAD. So if we were to reverse it, there you go. So you can see a pretty close relationship there as well, right? So then it begs the question, do you want to be long oil as well? And the question mark around oil, I think, is an interesting one at the moment. Let's see if I've got it on one of these. I've got gold, silver here. Let's just put, say, Brent here. We've got a very clear-cut downtrend. It's something that sort of Donald Trump has been favoring. But at the moment, we're sort of consolidating. I think these trade deals are going to start sort of making people feel a little bit more optimistic about the global economy. I wouldn't be surprised to start seeing a little bit more optimism coming into oil prices. And if that happens, again, that could lift the Canadian dollar. So the potential for us to roll over for the pound against the Canadian dollar. It's a really interesting one. And of course, in a week that sees the likes of the Bank of Canada interest rate decision, it's down to them. How do they view it, right? How do they weigh up the potential deterioration of the economy with exports to the US on the slide set against the rise in terms of core inflation? An interesting one, certainly, to follow in a week that's going to be absolutely massive, chock-a-block full of events, and it ends with the 1st of August, so the potential for tariff day. Or are we going to see him chicken out once again? Who knows? But it's certainly going to be an interesting one to watch. I hope this has been useful. Make sure to like, subscribe, and follow for more content like this. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day.